Good morning, everybody, and welcome to our real estate breakfast. I'm Alejandra Guzman, Vice President for Real Estate and Capital Investments at the New Orleans Business Alliance. And today we have brought a great lineup of speakers that will walk us through some of the real estate trends at a national, state, and local level. But before we start, I obviously want to thank our partner, the Urban Land Institute, and Nicole DePietro, who is our district manager. As you know, we have been hosting this real estate breakfast now in a virtual format for the past couple of years. And our intention is to be able to connect with our real estate community and bring insightful information. And I will also say that, coming to this type of events is critically important, particularly in these times of uncertainty. So thank you so much for being here. As a housekeeping item, we will have Q&A session towards the end of the presentation. So feel free to drop your questions during the presentation. There's a chat box dedicated for that, and we will be reading your questions towards the end. So with that, I do want to welcome our speakers today. We have three fabulous people that are going to give us an overview of the market. Justine Boyer, representing CoStar, is here with us today. Also joining us from CoStar is Itziar Aguirre, who's an expert on market analysis. She will be giving her input as well today. And finally, but not least, there's Benjing Lau joining us from STR. So welcome. Thank you so much for being here. And at this point, I'll hand it over to Benjing Lau for his presentation. Thank you, Benjing.
Great. Thank you very much for the introduction, Alejandra, and for having us here with y'all. I'll go ahead and get started. I know we got a lot of slides to get through. So again, my name is Benjing Lau. I'm with STR on the business development team for the hotels division, and going to give you a quick update on U.S. trends as well as the New Orleans, Louisiana market, and a little bit of a snapshot, high-level view of the state of Louisiana too, to have some comparison. So with that, I'll hear the agenda. Again, we'll do a quick U.S. review, quick market review. I'll share with you some pipeline information, and then a little forecasting, and then some information on STR's latest and greatest details. And then if we have a little time, some Q&A. So quickly starting off with the total US again. This is looking at, just for your reference, STR's monthly processing for October concludes next week. So we're looking here at September's data, the most recent data we have available on a monthly basis. This is total US. And while the US occupancy still sits below 50%, representing about a negative 28% decline in occupancy growth, you can see that we are basically filling almost 5 out of every 10 rooms. And then, of course, while the ADR growth has slipped from last year by nearly 25%, dropping ADR for the US to just under $100 as a whole. Again, this is just for the month of September. So by no surprise then, RevPAR growth has dropped by 46% from last year, and the September RevPAR sits at $48. Year to date, looking at total US through September of 2020, slightly better absolute values, as you can see here on the metrics key performance indicators, but unfortunately similar RevPAR. Just for reference, our transient RevPAR is down about 42, almost 43% compared to year over year last year, and then the group RevPAR down about 61%. So we account for transient versus RevPAR, transient versus group information, with groups being anything booked in groups of 10 or more bookings at the same time for a property. So that can include both leisure and business group, and conversely, transient can be leisure and business transient, just for your reference. And looking at demand, this is on a 12-month moving average. The reason why we use a 12-month moving average is so that it can smooth out some of the calendar shifts that might be experienced from holidays like the Jewish high holidays, Easter, for example, which can sometimes switch between March or April. So this is looking at the relationship between supply and demand growth for the entire US since 1990, again from a 12-month moving average. And you'll notice that over time, supply growth tends to lag behind demand growth in most cases. For example, in 2010, you see a sharp demand decline followed by a pronounced supply drop. So with this extreme drop in 2020, we'll likely see a similar trend in supply in the future. As FYI, those dips in demand that you're seeing are due to those downturns that we've experienced. For example, the Gulf War, 9/11, the Great Recession, and now COVID-19. Unfortunately, the scary part is that there's still no inflection point yet. And you've still got that steep cliff that you see at the very end of 2020. And looking ahead, RevPAR decline, for us, it's basically hit historical lows this year due to COVID-19. It's the lowest ever in STR's history, and we've been tracking this since the mid-late 1980s. So while RevPAR is slowly improving, as indicated by that little blip up to negative 46.1%, it's hard to say if this trend will continue as we get further into the fall. This is switching now to a quick weekly view of the data. I'm sorry, Justin, if you mind going back up one real quick. This is looking at last week was the single highest week for COVID-19 cases with over 550,000 new cases. Please keep in mind also, we just had our latest update of reporting available on Wednesday afternoon. So unfortunately, when I submitted these slides for the group, it was prior to that processing. So we do have some additional updated data. This is, again, week ending October 31st. So of course, with fewer leisure travelers, the air traffic number continues to drop. And that this chart is basically showing that relationship between what we feel is the relationship between TSA throughput checkpoint, as well as the checkpoint counts, as well as hospitality lodging usage. So this is now showing 2 weeks in a row. And with the latest data I just read, it's 3 weeks in a row where the numbers continue to drop in air traffic. So this leads us to quickly see that occupancy is sitting, unfortunately, stubbornly at or below 50%. In this case, we're now more than 5 percentage points below 50%. Total US occupancy for the week ending October 31st is 44.4%. And then Halloween, this is total US RevPAR percent change, week ending October 31st. Feel like these results were slightly better than the past because Halloween might have played a role last year as it fell on Wednesday, and increasingly meeting planners are trying to stay away from this quote unquote family holiday, if you will. So the comp might be a little bit easier, but again, it's still showing negative 48% RevPAR decline year over year. And then looking at US occupancy for the weekend, which is for us a Friday, Saturday, so October 30 and 31st, we're seeing that the occupancy was just under 50% at 48.8. One indicator of fewer vacationers is that the weekend occupancy dropped again from the previous week. Quickly showcasing the top 25 market performances for the US week ending October 31st. And actually New Orleans, Louisiana is a top 25 US market for STR. So I just wanted to highlight that New Orleans number on top, just to show that you can actually see New Orleans market came in quote unquote second, came in second place in terms of absolute occupancy for the week ending October 31st, sitting at around 52.5%, just under Atlanta for the week ending October 31st. And then looking at ADR, average daily rate, for week ending October 31st, again, New Orleans came in amongst the top 8 performers in the top 25 with a value of $107 ADR. And now quickly diving into the actual New Orleans market, STR has 3 submarkets that make up the New Orleans market, and you see that through the color coding here, Central Business District being in the red. And we have the key performance indicators, the key metrics here for year-to-date 2020. So through September of 2020, these are the numbers. Total room supply about -9% growth from last year in terms of available rooms. Room demand, unfortunately, is at -46%, creeping closer to the -50% in demand or rooms sold, as it's known. Occupancy sitting at about 41%, and the change from last year at -40%. ADR higher than the US year to date at $124, and then the RevPAR sitting at $51. Again, the occupancy is less than the US. The US is at 44.8, and unfortunately that occupancy percent change is also less than that of the US, which was at around -33.6%. Now, while the RevPAR year to date is better than that of the US, the pace is actually worse by about 5 percentage points. So again, by no surprise, RevPAR growth dropped by 56% from last year. These are what we're calling the cliffs of insanity. We have some Princess Bride fans on our team, so I kind of stole this tagline and slide, but we were looking, or initial slide, I overlaid it with New Orleans market information. So this is reviewing a focus on the occupancy and ADR growth changes for the New Orleans, Louisiana market, again on a 12-month move-in average since 1990. We do again call out those specific downturns in the US, like the Gulf War, 9/11, and in this case we added Katrina because that severely impacted the New Orleans market in the mid-2000s. So you can see here, it helps showcase how ADR growth was impacted by the occupancy growth, or in some cases lack thereof. For the most part, though, pricing power was affected by the major downturns since 9/11, none more drastically than, of course, what you're seeing now through COVID-19, at least so far. It appears from previous downturns that it took about 2 years for the ADR growth to, from peak to trough, or in this case, trough to valley, to go back to quote unquote peak numbers or normal numbers that we experienced back in 2010. Now, just again, since I'd mentioned the submarkets, this is just to showcase all the 3 submarkets that make up the New Orleans, Louisiana market for STR. And here, as a market year to date, just over 4 out of 10 rooms, again, were being filled. So, however, in this case, you see here, New Orleans Metairie Airport submarket is selling almost 1 room more out of every 10 rooms. With minimal business meetings and conventions, as well as outdoor activities being limited, both basically hallmarks of the New Orleans Central Business District and the Bourbon Street area, it's understandable that occupancy growth is down 50% year to date, and that the RevPAR growth has declined 55% year to date. Just a quick positive takeaway here, however, is that the submarket's pricing power has fared better than other key metrics, as you can kind of see from the slide. Sorry, Justin, thanks. And so looking at New Orleans occupancy for the week ending October 31st, this is looking at, again, jumping back to a weekly perspective, occupancy is slightly above that of the US at 52.5%, representing a -29.4% decline year over year. This next slide is quickly comparing how the market has done compared to the total US and the state of Louisiana for total occupancy, again, week ending October 31st. So that state metric at 57.4% occupancy for weekend 10/31st, 10/31 was leading both the market and the US. And then looking at absolute values on the next chart for ADR and RevPAR, we can see that when we compare the two, the market's pricing power has actually helped offset the occupancy to allow for similar RevPAR results with that of the state. So you see that the RevPAR at $107, the ADR at $107 for week ending October 31st was, again, as a top 8 performer in the top 25, helped offset that difference in RevPAR, or difference in occupancy, to keep a similar RevPAR with that of the state at $56. And then very, very quickly, just showcasing pipeline information for those that aren't familiar with how STR deems categories of our pipeline. We have properties that are in construction, which means that vertical construction on the project or physical building has already begun. we have the final planning phase, which means that construction will begin within the next 12 months. And then the planning phase, which means construction will begin in more than 13 months. So all three of these phases make up what we consider under contract in our total pipeline inventory. For New Orleans, Louisiana market, basically we're saying the pipeline projects, or seeing that those projects are remaining relatively steady in spite of the crisis or despite the crisis. We see that for the most current month, the rooms in construction are at around 1,400 rooms compared to the final planning and planning phases. In some cases, we will see that there is going to be some attrition or changes in phase category due to financing or projects that have not yet started with in-ground construction. Things may be pushed back due to financial issues and concerns, et cetera. But overall, the active pipeline and under contract rooms under construction, or excuse me, in contract are around 8,800. Just for your comparison, with about 294 properties in our census for New Orleans market, they're representing about 40,000 rooms. This in construction number is roughly 3.5% of the existing supply. Compare that to New York. New York is over 11.5%, I think, maybe even 12% of existing supply. So this is much more steady. And then very quickly, we want to introduce STR's latest and greatest. This is Forward Star Reporting. It basically collects and reports on occupancy on the books as well as pickup in bookings for the next 365 days. These reports will be issued on a weekly and monthly basis. So hopefully, if we are kindly asked back to do this presentation at another point in time, we may be able to have some data on forward-looking and pickup for the New Orleans market. What we're looking to gather is weekly reporting that will show the next 90 days, while monthly reports will highlight the next 12 months or 365 days. Basically, Forward Star will compare your property against market level data, and eventually upon sufficiency of participation, we will have comp set level data available. And then if you're curious, we are live in 55 markets in Europe and the Middle East. And of course, since we're now launching this product in North America very soon, we're targeting 8 specific markets to kick off the launch. And it's based on criteria on the left. But however, we're actively accepting property participation from other North American markets now. So if you know of anyone that are hotel owner operators, please let us know if they're interested in this area, and we'll try and sign them up, because as you know, New Orleans is in the top 25 markets, and I'd imagine after these 8 markets launch, they'll continue with pushing forward with the top 25. Again, these 8 markets that are part of the initial launch include San Francisco, Denver, Austin, Nashville, Minneapolis, Washington, D.C., Montreal in Canada, and Miami in Florida. And again, you know, if outside of these markets that they're welcome to participate, just let me know. And thank you so much for your time, and have a great rest of your day.
All right, thanks, Benjamin. It's always great to learn from STR and get your great hotel insights. We benefit so much, and so do our clients, from all of that great intel. So without further ado, I'm going to go ahead and jump into an economic update, looking at what's going on nationally and locally in the state of Louisiana and New Orleans. And then Itziar and I will jump into the different, the other property sectors we cover. So multifamily and office and retail and industrial. So I'll pass it to Itziar, who I think is on mute.
Sorry about that. Yes. So jumping into this slide, if we take a look over the past 6 months, how the economy has been going in New Orleans, it's no secret that NOLA has an outsized tourism exposure. Tourism is the city's largest employer, and roughly 1 in 3 jobs have been lost this year, according to the BLS and the city of New Orleans. And to put this economic impact into perspective, on a good year, it's about $9 billion, or roughly 12% of New Orleans GDP. So looking at this chart, in March and April alone, New Orleans lost more than 100,000 jobs. And since then, it's added back around 40,000, but we're still down about 60,000. And all of the sectors have been affected, but the biggest story by far, as we can expect, is the leisure and hospitality, which is still down by more than 30,000 jobs. And obviously any industry affected by social distancing and a slowdown in travel.
All right, so we looked at the employment change year to date, and then whether or not these industries can work from home. And you can see on the sort of the bottom right quadrant, arts, entertainment, recreation, accommodation, and food services. You know, these are sectors that are, you know, it's very difficult to work from home. And of course, New Orleans has a very large exposure to those sectors. We also have to, we'd be remiss to not look at oil and gas. What this chart shows in the dark blue is a North American rig count. It's at its lowest level since Baker Hughes started the count in the 1940s. In the orange, you have West Texas Intermediate crude oil prices, which, you know, are still in the low 40s, which are well below the sort of $50 to $60 range to drill, and probably north of 70 for a lot of producers. So it's still pretty tough sledding in the energy space. This matters because of all of the refining in the region. And if you add up manufacturing and upstream, you have about a 22% of GDP impact for the city there in New Orleans. So the only silver lining here is that sector had already experienced a pretty significant decline and had begun a recovery going into the pandemic. So it was already pretty lean going into it. I'll turn it over to Itziar.
Yeah, so if we can see on this chart that New Orleans has experienced the steepest drop in employment, but it's also anticipated to see the sharpest rebound. And looking here, we can see that the other three metros are tracking rather similarly.
If we look nationally, what's happened with New Orleans with the big decline in the accommodations or the hospitality sector is also a trend we've seen nationally with the slowdown in travel. And, you know, something I meant to mention on the energy slide is that something that's really hampering the energy space, as you'd imagine, is the decline in jet fuel consumption, directly related to people not flying. So that's something that needs to come back for the energy space to rebound as well. But you also see pretty broad-based declines in retail, trade, and healthcare. Again, these are all sectors that struggled with social distancing. But most sectors have been impacted, but about a third of the jobs lost have been recovered nationally. So again, New Orleans is pretty closely tracking the national trend there. So we looked at Oxford economics data. This is a year-over-year change in employment. You can see all the major metros in the United States have lost jobs. New Orleans seems to be one of the most impacted on a percentage basis. There are only a handful of metros that have lost more jobs relative to their total. And most of those, as you can see, are Northeastern and Midwestern Rust Belt cities that already had some pretty significant structural challenges to employment, with the exception of Las Vegas, another big tourism market. But on the bright side, this is Oxford Economics forward-looking forecast. So in the gray bars, you have their 4-year average forecast of employment growth over the next foreseeable future. And New Orleans actually ranks in the top 15 there. So I guess they're taking into consideration some volatility in the tourism sector and are seeing a pretty significant bounce back once we get through the pandemic. So we have a few different employment scenarios here from Oxford that they're testing. So this is nationally total employment. So this dark blue is the baseline from Oxford that we're using in our forecast. So in a base case, they're forecasting that we get pretty much back to the employment peak that we saw in 2020 by the end of 2022 or early 2023. There is a lot of uncertainty here. At this time, we're not really foreseeing a severe downside scenario where we would have a much bigger second or third wave, however you want to call it, another series of lockdowns. We're not really seeing that. A moderate downside could be possible, where you see in the green bar here. But to the upside, Pfizer and Moderna and a few others that I'm sure you saw are on pretty far along in their late stages of the vaccine development. So we could be seeing a vaccine being widely deployed by possibly early next year. Again, this is highly speculative, and I'm not an epidemiologist, but it is promising to see that news with the vaccines. And this is just the same, but for unemployment. This is just looking at the total unemployment rate. This shows nationally where the unemployment rate is compared to history. So at one point earlier this year, the U.S. had the highest unemployment rate it's seen since the Great Depression, which is not a great statistic. But now we've seen that unemployment rate fall back into levels that were more consistent over the past few decades. And it's generally trending the right direction, although we still have some pretty significant job losses and job loss claims.
So here we can see on this chart that Katrina now actually just pales in comparison to the number of job losses seen in all of these metros, barring Lake Charles. And as we mentioned earlier, New Orleans has by far seen the sharpest rise in the number of unemployed people.
And what's been encouraging to see is we've also seen the sharpest fall. So that looks to be trending the right direction as the city reopens. So this looks at U.S. new daily cases for the coronavirus. We are reaching fresh highs, unfortunately, during the fall season. This is something that was anticipated as we got into the colder part of the year. And we are certainly seeing that, but you really have to peel back the onion to see where the big hotspots are now. So this is from a couple weeks ago. This shows average daily cases per 100,000 people. That dark red, you can start to see that the hotspots are really emerging in the Midwest and the West and some of the more far-flung rural regions that did not experience the early exposure to the pandemic, like the East and West Coast and some of the denser cities in the South, and certainly Louisiana. So this is fast forwarding to Sunday, so you can see that has continued to grow quite significantly in the Midwest and West. It's yet to be seen if that will spread back to the coast as we've seen before, or what kind of containment measures we're going to have to maybe do again to combat this, which is of course a very contested issue. But you read headlines of places like Chicago and Detroit and other cities that are going, in New York, that are doing new lockdown measures. This shows total cases for the state of Louisiana. Actually, this is new cases for the state of Louisiana, which is the metric I like to use. It's a lot clearer to see the trend in the total cases. So you can see in March, there was that huge spike after Mardi Gras. This was mostly the New Orleans area. And then what's interesting here is that the rest of the state saw a much bigger peak in July, which is similar to what a lot of nearby states like Texas saw. It seems like that the new cases have come down quite significantly. We haven't contained this in Louisiana nor the United States as a whole, but it's encouraging to see this moving, generally speaking, in the right direction in Louisiana. So this looks at actually the total cases by parish. And I was actually it was interesting for me to see that Jefferson Parish actually had more cases than Orleans Parish overall since this started. But you also see some hot spots in East Baton Rouge and Caddo. And let me just move on to the next slide. So this is looking at Orleans Parish new cases. So, and then this color codes it by threat level. This is what the city of New Orleans uses from the Louisiana Department of Health. So again, you can see very clearly after Mardi Gras, that huge spike in Orleans Parish where you had nearly 450 cases a day. Now that's well below that level where you have less than 30 new cases a day. So very promising development there. So here we looked at we looked at open table restaurant reservations data. This is daily data. And this basically shows the percent change year over year of restaurant reservations. So this dark blue line or light blue line, however you want to say, highlighted, shows New Orleans. So New Orleans has actually been one of the slowest cities to recover restaurant reservations data. This is not surprising given the major slowdown in tourism, and also that the city instituted some pretty strict containment measures to combat the virus, which it's clearly been pretty successful at doing. But you can see the trend there that the cities that have been slowest to reopen are sort of your coastal gateway cities with a big exposure to tourism: New York, Seattle, San Francisco, Honolulu. At the other end, you have your sort of your Sunbelt cities in the red states that have reopened quite quickly: Scottsdale, Tampa, Fort Lauderdale, San Antonio. Just kind of interesting to see that trend. And this is what this looks like in bar graph form. It's the same data, just shown a different way. What has been encouraging, what's held up New Orleans and Louisiana at large in the country, has been this major physical income support. So, what we've seen here, we had the one-time checks in early April and May that started to burn off. And then you had the unemployment insurance start to set in May, June, July, as well as some of the PPP funds and some of the gig funds, which helps New Orleans as well. This has started to burn off, going into this current election period that we're in. So this is from the Hutchins Center, and it shows this huge fall off in stimulus. Since we're still in the thick of this pandemic, I think there is a broad bipartisan consensus that we're going to need a new stimulus bill. So that's a big point of uncertainty, because we're waiting to see is Trump going to help pass that through before January, or is that going to come after Inauguration Day? We don't know, but we think that the stimulus bill is forthcoming, certainly, which is desperately needed. You could show, this is from the Federal Reserve Bank, so it shows their monetary policy. So you can see they've increased their balance sheet and they're buying quite significantly. Rates are basically at zero, which has driven a lot of home buying and things of that nature, which has supported the market. This is from Oxford and the Bureau of Labor Statistics. So this is the baseline GDP forecast. So again, we see a pretty sharp recovery this year, which similarly could be challenged depending on the timeline of the pandemic recovery. And this is the treasury spread between the 10-year and the 3-month treasuries, which is a leading indicator for recession. So you see that has started to widen out a bit, which is a positive development. It shows that we're kind of headed back towards economic recovery. And then this, to wrap it up here, this is the top and bottom population growth markets, the forecast from Oxford using census data. So New Orleans, in terms of population growth, is sort of not too hot, not too cold, but it's good to see it at least in positive territory. So with that, I'll jump into multifamily, and we'll go through these property types pretty quickly here, since we're sort of running out of time. But so this shows apartments.com search activity. So you can see that after a huge dip in March during the beginning of the pandemic, search activity has reached new highs for apartments in New Orleans, which is a positive development. We'll show a few of these. This is the supply demand vacancy. So vacancy in the green line, and then new supply in blue, and the change in absorption in orange. So the vacancy rate for New Orleans multifamily had compressed quite significantly from the financial crisis all the way to right before the pandemic. And then you saw this huge surge of new development, mostly in the warehouse district and downtown. And, what's happened there is we learned that a lot of several of those buildings were filled up with Stay Alfred and Sonder and sort of Airbnb type users, which have pulled back in a pretty big way during the pandemic because of what's happened in the hospitality sector. So that sort of negatively impacted absorption there to some degree. Well, at least we forecast that it will, because we've seen a pretty interesting uptick in absorption in New Orleans, although most of that is sort of growth in the suburbs, which we'll touch on. And we see that construction pipeline coming in a bit. So we do see vacancies rising, but not to a terribly unsustainable level, about 9% before recovering. So this is a trend that we've seen nationally, and this is for New Orleans. So you can see that the rents in downtown have gone down quite significantly with that onslaught of new supply. And also, look at what's happened in the suburbs. What we've seen across the country is that during the pandemic, people have they've sought out larger spaces, more bedrooms in less dense areas because of social distancing. We also saw concessions, rise somewhat gradually since the beginning of the year. We saw a big spike in August, but that's come in a bit with some renewed leasing. And then, we do see a slight decline in rents before they recover, hopefully in 2022. So we look at transaction volumes. These are down a bit this year. I believe they're down about a third. But what's been interesting to see is that there's still a lot of interest from the private capital sources, private buyers for value add workforce housing, which seems to be hot all over the country and in New Orleans as well. Even with what's gone on with the service industry, there still is pretty high demand for Class B, and C housing. So something to keep an eye out for. Something that could, however, challenge the dominance of the apartment sector, as we've seen so much interest this past cycle, is that the moratorium on evictions officially ends at the end of this year on December 31st. So hopefully that is extended given what's going on. If there was a mass wave of evictions, that could certainly harm the apartment sector, not just New Orleans, but nationally. So something to look out for there. And as well as the apartment market really needs that stimulus, as does some of the other sectors, which we'll touch on here in a second. Another threat to the apartment market is that millennials have entered their prime home buying years and interest rates are at an all-time low. So you start to see folks buying new homes. And CR and I would be two of those that fit that demographic. And so, this is a large cohort that is, renting less, moving in the direction of home ownership. But at least it is promising to see this economically overall. So with that, I'll turn it over to Itziar to talk about New Orleans office.
Great. Yeah. So jumping into this really quickly, as to be expected, leasing volume is down significantly, about 40% compared to the same period last year. And with just all this uncertainty on when most of New Orleans office workers are going to return to office buildings, leasing activity may be slow to recover in these subsequent quarters. So most of the recently signed leases have been for spaces below 2,000 square feet, which is actually not uncommon for the area. And also about a quarter of all leases have occurred since the outbreak in Medellin. One of the largest recent leases occurred in June, when about 20,000 square feet of space was committed in the Lakeway Center in Medellin. And then more recently in August, forgive me if I butcher this, but Molado, Bland, LeGrand, and Brackett committed to about 23,000 square feet of space in the iconic Hancock Whitney Center in the CBD area. So moving now to the baseline scenario. So since 2010, on a net basis, more office space has been taken offline than added actually in New Orleans. There's been nearly 3 million square feet of net demolitions, mainly in the CBD, supporting a lot of just conversion of older legacy, underutilized office buildings into more higher yielding, often apartments, condos, and even hotel rooms. So as we can see on this chart, this actually effectively compressed the office vacancy rate. And by 2019, that rate had fallen to a record low of 6.2%. But the vacancy rate has trended upwards in recent quarters, and still, though, it remains quite low by historical standards. Recent move-outs, for example, occurred just this past third quarter. The New Orleans Regional Transit Authority, just to name a few, vacated about 60,000 square feet from the New Orleans East submarket, and Trumpet Advertising vacated about 25,000 square feet from the CBD submarket, and Chevron vacated around 22,000 square feet from the Mandeville Covington submarket. So with an estimated, and I'll wrap this slide up, with an estimated 84,000 square feet under construction, we're actually really well below the 2016 peak, when there was more than 300,000 square feet of office space under construction. So talking briefly about net deliveries, we can see here that New Orleans is among the few metros in the nation that posted negative net deliveries as a share of inventory over the past 4 quarters, which speaks on the demolitions that I just mentioned earlier. It's a trend that's just persisted. So in terms of office rents, rent growth remains pretty modest, about 1%, but interestingly, it's actually slightly outperforming the national average. And as you may recall, prior to this pandemic, office landlords here were struggling a bit to grow rents. And during this past decade, rent growth grew by about 4.5% cumulatively versus the national average of more than 25%. So rents here could turn negative over the next several quarters, though. So we're going to be keeping a close eye on that. But that said, there may be a very sharp rebound during 22 and 2023. That said, this forecast includes many unknowns, and it's based on historical trends. So we have to take this with a grain of optimism. And then finally, on the transaction volume, sales volume here has averaged around 125 million since 2010. And we can see here that 2015 was a record year for New Orleans when the sale of Hancock Whitney Center occurred, which sold for around 165 million as part of a 9-office building portfolio deal of around 420 million. And that pushed sales volume up to more than 300 million that year. Also an interesting fact, during 2019, price per square foot peaked at around $136, but it has come down a bit. And like leasing volume, sales transaction volume is down about 50% compared to the first 3 quarters of last year. And local and national buyers have actually been equally split since March, which is interesting because usually national buyers account for a larger share of transactions. The submarkets of Medellin and Mandeville-Covington have accounted for almost 40% of all office trades since March. And most of what has sold has been small assets, almost entirely 2 and 3 stock in around 20,000 square feet or less.
All right, so I'll jump into New Orleans retail here real briefly. So we're also seeing retail leasing activity down in New Orleans pretty significantly during the pandemic, which is likely a little surprise. Out of all the property sectors, retail's been hit the hardest, perhaps second most to the hotel sector, and that's the result of a lot of national trends, which I'll cover here in a second. So, one saving grace for the retail space, both in New Orleans and nationally, is that not a lot of new product delivered since the financial crisis, given the headline risk from the growing e-commerce sectors, the Amazons of the world, and big retailers going multi-channel. So this was certainly the case in New Orleans. There was a good amount of net absorption, particularly between 2012 and 2017, which started to fall off over the last few years, but that compressed vacancies to about 3%. We are seeing a gradual incline in the vacancy rate, but we still don't see it rising above 6%, which is still pretty low on a historic basis. This year was the second lowest amount of absorption on record after 2008. So in 2008, during the financial crisis, New Orleans saw negative net absorption of 1 million square feet. This year, it's on track to be about negative 640,000 square feet. And we like to tie the retail trade sector to leisure and hospitality and say that they're related. In some markets, they really are pretty strongly related, and to some degree, they are in New Orleans. If you think about all of the retail in the French Quarter and downtown overall, but a lot of the big move outs in New Orleans this year were really more big box retailers that went bankrupt nationally. And those are sort of your department stores in the western suburbs in Metairie, in that general area where you see Stein Marts and J.C. Penney's and others sort of closing up shop. So that had the biggest negative impact on the retail sector. And, we are hopeful for the sector. What we saw going into the pandemic is that experiential retail was playing a bigger role. Gyms, restaurants, entertainment, sort of all of the things that have been that have seen lesser activity during lockdowns and social distancing. So once we get through this pandemic, we're, given that there's such low new supply and that the fundamentals look pretty good in terms of vacancy, we think that it's headed the right direction, but the sector does face some pretty significant challenges. So if we look at rents, we do see rent growth turning negative this year, which is probably not that surprising, and then rebounding quite briskly. As Itziar alluded to, this is based on the historical trend. It's based on a pretty optimistic forecast for a sharp rebound in New Orleans job market. So we'll continue to monitor those trends as well. And then if you look at transactions volume, that's also down quite significantly. In New Orleans, you tend to have more local private players. And we've just seen a lot of capital sources on the sidelines during this current pandemic period as buyers and sellers figure out pricing. Something that's helped the retail market quite substantially has been the CARES Act and all of the stimulus. Without this, you would see that sort of the dotted line here, perforated line. And with it, you see this, that nationally, folks have just had a lot more money to spend. Some of it's gone to saving, but a lot of it's gone to paying bills and buying things, which has helped the retail sector. So this looked at, on the x-axis, the change in mobility and social engagement, and then total consumption on the left side on the y-axis. So Louisiana is in an interesting category of several states in the South that actually saw an increase in consumption during the pandemic. And we had an interesting question from someone, from one of our clients after the last webinar, and they asked if the unemployment insurance benefits were concerned, since a lot of folks were actually receiving more money collecting unemployment insurance than the normal paycheck. And there was a New York Times study that looked at average income versus the UI benefits. And Louisiana was one of those states where the UI benefits actually did quite substantially exceed wages. So it's likely that the stimulus actually did give a boost to consumption from the local population, which is something that's interesting to look at. With that, I'm going to turn it over to Itziar to wrap up with industrial.
Great. So the industrial sector actually appears to be holding up the best compared to the other property types, and leasing volume is down just about 10% compared to the same period last year. The Elmwood-Harahan submarket accounted for most leases signed during this time for more than a quarter of all leases. And this is unsurprising given that it's home to most of the industrial product in New Orleans, or the largest portion of it. One of the largest leases signed directly recently was by Medline, which committed to about 200,000 square feet in Covington in August. So much like the office sector, the conversions and demolitions of industrial facilities have actually resulted in a reduction of industrial stock this past decade. And for the third straight calendar year, this resulted in a net reduction in New Orleans in 2019, which resulted in pushing vacancies to a record low of around 3% last year. So the vacancy rate has trended upwards in recent quarters, but still remains very low by historical standards. And also worth mentioning, just with an estimated 120,000 square feet under construction, New Orleans is well below the 2014 and 2015 peak when there were more than 500,000 square feet of industrial space under construction. The only project, as you all may know, is currently under construction is a $77 million processing facility by Fuji Vegetable Oil in the outer Jefferson Parish, and it's scheduled to be completed within the next 3 or 4 months. And this project, which is going to be adjacent to the former Avondale shipyard, represents the attraction of foreign direct investment to this parish, posing as the market's potential breakthrough into a large-scale industrial development. Moving on to the next slide. Sorry, Justin. So if we take a look at this chart, as of August, retail sales hit an all-time high of 500, almost $539 billion in April, which was a low of $413 billion. E-commerce sales spiked at 17%, which is impressive. And that said, folks are getting out there and they're buying stuff. So I would anticipate long-term trend of e-commerce settling in at about 12%, if not more.
Yeah, so just to add to this real quick, so that huge drop that you see, that was folks, and why you see that big jump in the red line, the e-commerce share, is just that folks were not going out to retail stores, to traditional brick and mortar. They were buying more online, and so that's come in, but still that e-commerce share has settled substantially above where it was before the pandemic.
Yeah, so looking at the manager index, this is a good leading indicator about the overall health of the economy. And above 50 signals an expansion, below 50 typically signals a contraction or kind of where it's headed. And it's encouraging to see that manufacturing and non-manufacturing has rebounded quite substantially. It makes it appear that we're recovering, and it paints a pretty good picture that we are on the right track here. And another interesting point is that manufacturing did not decline like it did during the financial crisis. So jumping in briefly to rents, rent growth was a bright spot industrial this past decade, particularly evident in 2018 when rents grew by around 6%. And rates were more than 20% above their pre-recession peak right before the pandemic. Right now, rates have adjusted by about 3.7% over the past year, which is slightly below the almost 5% average annual output that we saw during the prior 5 calendar years. Combined manufacturing and transportation and warehousing make up more than a quarter of New Orleans area employment. And the manufacturing industry in particularly may be hit harder with a global economic cool down. So we're gonna have to keep an eye on that and see how it performs. We can see here that an abrupt decline in asking rent growth over the near term could very well occur. And then rents could turn negative over the next several quarters, followed by a sharp rebound during 2022 and 2023. Again, this forecast includes a lot of unknowns. So we'll have to keep a close eye. And then finally on the transaction volume, transaction activity in New Orleans industrial almost completely shut off in the months following the onset of the pandemic, but it did recover nicely during 20Q3. To compare with the same time last year, sales transaction volume is down about 25% this year. And buyers have been primarily out of state private capital, with the local ones kind of taking a pause. Transactions since March have been fairly evenly split throughout New Orleans, though some areas have garnered a bit more attention, specifically Kenner, Elmwood, Harahan, and West Bank combined, which the three of them have accounted for about 40% of all the trades since March. Most of what's been sold has been smaller assets, under 40,000 square feet, primarily 1 and 2 star stock. And one of the largest properties to trade, which I'll call out, occurred in August, when Illinois-based Medline Industries sold its 3-star 197,000 building in the Mandeville Covington submarket to Louisiana-based Sealy and Company for almost $14 million. And,
all right. Well, thank you all for your time. And we have our contact information here. We're always here to help our CoStar and STR subscribers with any questions you have, any market presentations. So thank you, Benjamin, and thank you, Alejandra, and the whole team, Valerie and Nicole, and the whole team from NOLABA and ULI. I've got their slide to end on here, and I think that we have at least a few minutes for questions. I want to be respectful of everyone's time.
Yeah, so we have a couple of questions, and we do have a time for a good conversation. Thank you again for being part of this morning's session. I do want to add before we go into Q&A that NOLABA has contract with CoStar, and we are able to pull down reports for the market. So I'll encourage those that are participating today to reach out to us to continue to get information and monitor the market. I think there's multiple things in the pipeline that are coming up that will dramatically change the market. You mentioned a couple of them. The vaccine is on its way. So once that happens, it most likely will increase consumer confidence, and we'll see that reflected in our market. Then obviously the elections and you know, as things stable down, I would think that will have an impact as well. And there are other elements to consider as well. So I think that it's important to continue to monitor information and see how things develop. But with that, let me read a couple of questions that we do have from participants. We have really good questions here. I'll read one related to the election. Do you have any thoughts on how the uncertainty around the election may impact the economy until January? So that could be to any one of you three if you want to address that.
Yeah, I'm happy to jump in. I think the biggest downside risk to what's happening with the election results is just that it's delaying the passing of a stimulus bill, which will push out. It'll impact, particularly the hospitality and retail sectors. But generally speaking, it'll impact all Americans if we don't get something passed there, which has really helped support us through this really difficult time. It's helped support our GDP and our jobs, even though we've seen significant job growth. So that's probably the biggest threat. The other thing would be the eviction moratorium and what happens there if that gets extended. That'll have a big impact on the multifamily sector.
Thank you for that. I'm going to go back to you, just so hold your thoughts. But before we do, I do want to go over to Benji. Somebody asked if there's information of how much of the New Orleans occupancy can be attributed to the evacuees from Lake Charles after one of the hurricanes we've had,
Sure.
So yeah, so in essence, can you drill down a little bit into to that data and somewhat understand why we're presenting those numbers?
Sure, that's a great question. That data, unfortunately, we aren't able to determine, the coding of what the lodging performance might be. If contractors are there, or possibly evacuees, or those just trying to get out of the path, that certainly does help elevate occupancy numbers in most cases that we've seen in the past. Like, for example, hurricanes that have hit Florida, there usually is a bump in those southeastern states markets that are part of, within or amongst the part of the path for evacuation. But it's hard to say how much of that is actually due to that, because unless a property, all we can track is necessarily transient or group. We don't necessarily say, hey, it's a FEMA rate code, or it's a branded property special code for what they use. So unfortunately, we can't drill down that specifically. But yes, you can attribute a lot of, in many cases, you can attribute a lot of the spike due to emergency situations like that.
And I would just add to that. Oh, sorry. Go ahead.
No, go ahead. Please go ahead.
Yeah, I just wanted to add to that. That brings up a good point. We've had a lot of questions from clients about the negative economic impact of some of the hurricanes in tropical storms we saw this year. I think was it 7 storms that Louisiana saw? It has to be some kind of record. Thank God, fortunately, it seems like a lot of those storms were pretty fast moving, and the economic impact was quite minimal to the cities. We haven't seen anything super discernible in our data that shows that it threw off any of the big Louisiana metros, which is great.
Well, I was going to add, and I'm going to mix this comment to what you just mentioned about occupancy and rent from the residential side. So Benji, do you guys measure or track flights as well? Because it would be interesting to see if New Orleans continues to be a destination and that could explain a little bit of why we're a selected place to visit when compared to other touristic destinations. And the reason I say I'm going to mix this question is because from the residential side or from the renter perspective, I've had some local comments stating that it seems that there's a lot of young professionals coming from bigger metros that are being, that they're allowed to work from home, that are selecting New Orleans as a place to establish, at least for the next year. So I wonder what your thoughts are about that, if you're observing similar trends, and if that will have an effect on our market.
Sure. So personally, if I had that option, or given a different phase of my life, I think New Orleans would be top of the list for me to move to and work remotely.
I agree.
Yeah,
Wholeheartedly.
it's a great place to be. I don't know how much work I'd actually get done, but no, it's a great place, and I'd probably be 20 pounds heavier for sure. But anyway, to go back to your question, unfortunately, the data that we receive is direct from source from hotels. So it's just purely lodging accommodations information, information on total rooms available that they have on a monthly basis or weekly, daily basis, total rooms sold, and then the total room revenue. From that's where we compile those metrics that we have. We do, however, provide some reporting to respective DMOs, destination marketing organizations, or CVBs, more commonly known, like the New Orleans Convention and Visitors Bureau as a client. They receive data from us, and I believe they probably take that information and combined with their visitor statistics can accommodate and provide additional insight into travelers, intent and the types of demographics available.
Alejandra, and to your point about folks moving from other metros, I mean, that's certainly something that we've seen nationally. We've seen folks moving from the coast to places like Colorado, outdoors. New Orleans, it didn't strike me at first, but, it makes a whole lot of sense. And that might explain some of that big uptick in apartment absorption that we saw even during the pandemic.
Well, thank you for those thoughts. I have more questions coming in. Somebody's asking, are you seeing a massive shift in money from one sector to another? I'm hearing a lot of my clients shifting from hospitality into other sectors, for example. I'm not sure if this person refers to for instance, we've seen cases in which hotels are adapting their rooms to be rented as an apartment, for instance. So what are you seeing in the market as it relates to this?
So the first thing that comes to mind is that whenever there's a big economic downturn, the capital that is sort of earmarked for opportunistic plays can shift around more easily. So there's a lot of interest in distress. And the hotel sector has more CMBS delinquencies than, say, retail, which has more than office, which has more than multifamily. It's really hotel and retail that have seen some of the, more of the delinquencies, but we still haven't seen a whole lot of distress nationally in either of those sectors. And I think Benjamin might, you might be able to echo those comments. That's something that I heard from Jan, that we just haven't seen it materialize. Similarly, in Houston during the shale bust, we didn't see a whole lot of opportunities materialize. There's a lot of capital out there, and these landlords and owners are able to recapitalize, refinance, pretty easily these days. A lot of cheap money out there. As far as redevelopment opportunities, the trend that we've seen in New Orleans is office buildings being converted into hotels and apartments. And given how popular downtown is and how the office sector generally is kind of, more of a slow growth sector these days, I do see some of more of those conversions happening if where possible. As you mentioned, Alejandra, to provide more housing to folks moving to New Orleans and that kind of thing.
So the other thing that I wanted to introduce is how can we use the information that you guys provide to support our businesses? I know Benjamin mentioned that there's free market updates available. So can both, from CoStar and also from STR, can you tell us where we can access this information? What do you recommend we look at for just to, to keep a pulse on what's going on in the market?
Yeah, I can speak to CoStar, and then if Benjamin wants to speak to STR. In our markets and submarket section of the analytics tab in CoStar, we have all of our market and submarket reports for the for New Orleans and the Louisiana metros. Those tend to provide a lot of great data. You can utilize property search to do custom searches of an area and pull things like demographic data for a certain neighborhood or area, which can be very helpful. We do have also in the markets and submarkets tab, there are different map layers where you can look at all kinds of data overlaid onto those maps, like median household incomes and percent of college graduates and demographics and all kinds of things that could be helpful. So there are a lot of tools baked into CoStar, and we are always here for our subscribers as a resource. So feel free to reach out to any of us if you have any ideas. I see Drew McDaniel's on the webcam, and I have kind of like a shameless plug. We have he's the CoStar sales contact for the state of Louisiana. So I think it's just D McDaniel at CoStar.com. Is that right? Yeah. So feel free to reach out to Drew if you want to increase your subscription. But there are a lot of tools out there, and he can do. Their group does trainings and demos and all kinds of stuff. Benjamin, did you have anything to add?
Yes, thank you, Justin. Appreciate that opportunity too, Alejandra. So in terms of market and nationwide information, actually globally, if your folks are not yet familiar, we own and operate our digital media arm called hotelnewsnow.com, which is part of CoStar, of course. And so if you go to www.hotelnewsnow.com, there are a myriad of articles and updates daily, including you can sign up for a free e-newsletter called Top 5 Things to Know. And it truly is, the top 5 things to know on a daily basis, sent out, I think, around 10 o'clock Central Time, with mergers and acquisitions updates, anything hotel hospitality related, investment opportunities, related to the hospitality accommodations landscape. So definitely feel free to check that out. And then, of course, it includes other webinars, recordings. There is a section that hosts up to 90 days worth, rolling 3 months basically, of presentations that we as STR employees are giving globally. So you can access that. You just create your own free login and can view the presentations and any updates through that website. Again, www.hotelnewsnow.com. That's probably the best source for keeping up to date with STR information. Thank you.
Okay, great. So as a reminder, well, thank you for that those resources. Also, through the ULI, we do have a lot of information and articles that are published constantly, so that's a good resource for everybody. And through NOLABA, we also have different tools and analysis that we can do for you. We use CoStar for our analysis, so make sure to visit nolaba.org or reach out to me directly. We are running a little bit out of time, but we do have enough time to have a couple of more questions. I have one myself. And while you were presenting the information on retail, a lot of what's been discussed around retail is that there's a trend that has been accelerated, and a lot of, like you mentioned, a lot of the online sales are going up a lot. So although essentially every business is evaluating their real estate needs, I think retail is a great example of how square footage is shrinking, right? So so in essence, my question is, how are you guys discussing how to measure metrics to evaluate the health of a market? Because industries are changing and their needs are changing. So because sales are going online, it doesn't mean that a retailer is going out of business. It's just that we're doing things a little bit different. So again, my question is, how are you guys holding discussions on what metrics to evaluate, and what does it mean to have a healthy market with these changes?
Yeah, I think that's a good question. The way that we look at markets is kind of how you've seen. We look at supply, demand, vacancy. We look at rent growth. For retail, we would look at, so if there's strong absorption in a market for retail, that's typically a good sign. We might look at it in concert with industrial, since a lot of what's driving industrial absorption is e-commerce growth, to try to paint a fuller picture. I'm pretty bullish on New Orleans retail in the sense that particularly in downtown, is so tourism focused. It's by its very nature experiential. So I always think there's going to be a place for that type of foot traffic downtown. As far as is in Metairie and in Lakeview and Elmwood and on the North Shore, we've seen discount retailers, generally speaking, nationally, like Dollar Tree and Five Below and others like that have taken big blocks of space. We've seen gyms take a lot more space. So retail is always evolving. It's always changing. Consumer trends, consumer habits are always changing. So we just think that retail is going to continue to evolve. And we do think we're going to get through this pandemic and life will get back to normal. It did in 1918 after the Spanish flu. Everyone said that Manhattan was dead, and that certainly did not turn out to be the case. So once we get the vaccine and get through this, I think that people will be surprised how quickly things return in relative normal.
Great, thank you. It's Tiara, I know that you've been wanting to say something, and could you give us somewhat of concluding remarks on how we can interpret the information that you guys just presented, and hopefully you can give us a positive picture of what's coming in the next few months.
I just basically echo what Justin just said. Once the vaccine comes and people feel more at ease of getting back to their normal lives, I think we should anticipate a pretty strong rebound across the country.
Well, on that high note, I want to thank everybody again for being part of this session. We really appreciate your time and expertise. Again, I will encourage everybody that has attended here to stay in touch with Nicole and I. There's many resources that we can offer to support your business and help you keep a pulse on the market. So with that, we are concluding our session. Thank you again, and we hope to see you soon.
All right, thanks for having us. Appreciate it. It's a pleasure. All right, have a great weekend. Thank you.
Thank you.
Thank you very much.